If you own a business with one or more partners, today's tip may be a nice complement to your tax planning toolkit. During our consultations over the last decade, we have found a common theme emerge amongst business partners when it comes to how they handle business expenses that are personal in nature. The Internal Revenue Code states that all expenses that are both necessary and ordinary for a business to operate are deductible. But in most cases, the IRS leaves the costs associated with those business expenses wide open. Let me give you a few examples. Let's say you own a construction company with a partner. The purchase of company vehicles to allow you to travel to job sites would be justified. You want an F-150, and your partner wants the new Platinum F-350. One truck costs $60,000 and the other costs $90,000. Or you want to hire your spouse for some light office work and add your spouse to the company 401k plan to reduce your taxable income. But your partner doesn't see the value of that position and would prefer to save money on the wages, payroll taxes, and company 401k matching costs. Some owners don't get too picky with these partner disparities. But when you stack several of these discrepancies on top of each other, finding a way to equalize these inequities can be pretty valuable. This is where a management company becomes a great solution. Take a look at this sample org structure where one or more companies is owned by individuals. Then take a look at one of these alternative structures. In scenario A, we establish a management company as a middle tier in your org structure. All of your K1 income hits the management company first before flowing up to you as an owner. But inside the management company, you expense the company vehicle of your choice, and you hire your spouse and get him or her on the 401k plan, all paid for out of your own S-Corp, fully deductible and excluded from your income, yet leaving your business partner to have no part in your business justified and personally paid expenses. In scenario B, we don't mess with the ownership structure of your primary business, but we do add an additional S-Corp on the side. You would push some of your compensation over to the S-Corp and start taking your reasonable wage from the S-Corp, while added other expense that can withstand the test of ordinary and necessary costs of your business. As long as we can establish a business purpose for the expenses, a structure like this starts to open the doors to a variety of options you likely have not explored previously. Examples include hiring your spouse and children. We'd need to establish a reasonable wage for them, but once we do, we now can consider tuition reimbursement plans and 401k plans. 14-day rental rule. We have talked about this in a different video, but if you need a refresher, take a look at that video and see if that could be an option. Company vehicle, which is still subject to all of the same business use provisions we have talked about in other videos. Company board meetings, including some light travel or meals. Finally, here are two things to keep in mind here. First, any business expense we aim to take in a management company is subject to all of the same deductibility rules of the IRS. And second, creating a new company will cost about $700 to form and will add to your tax and bookkeeping engagement with our firm. So we want to do some analysis to determine how much you might have in qualified deductible expenses to make sure the tax savings will justify the added headache and costs associated with a new company. Give us a call to talk more specifics and see if this might be a good fit for you.